Hello everyone and welcome back. We're back after a short hiatus from the channel. I apologize if you were looking forward to the weekly videos, but we are back now. So this week we're going to be covering balance sheets, how to analyze them, and how they play in a very important role in accounting and in finance. So I hope you enjoy this one, and I'll see you next week. Hi everybody, and thank you for tuning in again. This is the video on balance sheets we're going to be covering today and how to analyze them. The term balance sheet is thrown around a lot in finance and accounting, and in a way it's like a hot potato. It's essentially a financial accounting document providing a snapshot of a certain entity's financial situation at a single snapshot or time period, and this is really important. The entity can be something like a firm, a sole proprietorship, a corporation, a limited liability company or an LLC, or a business partnership, and any of these can be the entity, as I'll talk about below. The balance sheet of the entity also provides a closer look at its capital structure, and we'll see this when we do the example. Its name is fairly self-explanatory. The left-hand side of the balance sheet shows all of an entity's assets. This could be anything of value, essentially. The right-hand side on the other side shows the entity's liabilities, but this also combines within it the equity ownership or stake that the company has in companies. Generally speaking, the balance sheet should balance, meaning that we have the accounting equation as follows. So we should have that assets is equal to liabilities plus the equity ownership in the company. This insinuates that equity ownership of an entity must always offset the difference between assets and liabilities, and this is something you should definitely remember when you're looking at a balance sheet. The net difference is also called the equity ownership, as we've talked about before, or simply the entity's equity, which is a more common term used for this, which is assets minus liabilities. So a common problem with balance sheets is their need for an exact dollar valuation of both the asset and liability in question. Some are very illiquid and are hard to value, which poses problems for this. And others may require pricing methods and other complicated formulas in order to derive their true value. So due to the difficulty of doing so, balance usually display only cash or liquid assets and liabilities to keep things simple. Some examples of assets include things like cash that a company or entity has at hand, the revenue or accounts receivable that they incur, any physical capital that they might own, such as equipment, real estate, or machinery, any inventory that they have of a product, and carried forward revenue from previous periods. Liabilities are essentially costs to an entity, representing means of cash outflow. And some examples of liabilities include things like lines of credit, which they might hold, term loans, revolving loans, bonds that are issued, and day-to-day business costs, also known as fixed costs in economics or accounts payable. And finally, our last category is ownership equity, which is essentially an asset and includes things like the capital stock owned by the entity and its retained earnings, which are earnings that are kept from previous periods. To better understand this, let's take a look at an example here. So we can look at this in a T-chart form, which is a very common way to do it, although mostly it is on Excel. But here we have assets and liabilities, and equity is on the liability side. So here I've done machinery of 100,000, warehouses worth 900,000, and trucks that the company has worth 200,000. And then for liabilities, we have the term loan, 400,000, and accounts payable worth 600,000. And the capital stock ownership is 200,000. So the total for liabilities is $1 million. the total for assets is $1.2 million, and the total stock or equity is $200,000. So you can see here, the total on both sides has to be equal. In its construction, the balance sheet always balances, as we've talked about before, through the ownership equity portion. This also acts as a type of residual to capture discrepancies between assets and liability values. It's also commonly used throughout finance and accounting and is called double entry bookkeeping. And the beauty of this is that if the balance sheet doesn't balance, we know right away, and auditors also know, that something isn't right. It could be a mistake, or it could be fraudulent reporting. Balance sheets in the United States must adhere to the generally accepted accounting principles, also called GAAP. This allows for easy balance sheet comparison over time and across companies. It's also very easy for auditing and investor utilization for fundamental analysis, which becomes very important. And investors also utilize the balance sheet to determine meaningful ratios that they can use for their analysis. But in order to see the whole picture, we should consider all three accounting/financial statements together. And these include the balance sheet, as we've talked about, income statements, and cash flow analysis. And we'll do these in a future video so you have a better understanding of them. So we'll see you guys next week.